Okay, come to this question number 1. A Limited purchased 10,000 equity share of B Limited at rupees 15. Total share of B Limited are 50,000. 10,000 upon 50,000. How many shares they are holding? 20%. With 20% you can have significant influence. Date of purchase 1/4/18, 31st March 19. Fair value of share is rupees 21. 31st March 20. The fair value of the share is rupees 17. Journalize assuming cost model, FVTPL model or FVT OCI. So first we need to check what is the status of this investment. Is this investment a subsidiary, associate or a joint venture? So right, first check whether the investment is subsidiary, associate or joint venture. If it is none of the three, then separate financial statement will not apply. But if it is one of the three, then separate financial statement will apply. So check, is it a subsidiary? Is it a subsidiary? So the condition for subsidiary, generally voting power is greater than 50%. Generally voting power is greater than 50%. Actual 20%. So remark, not a subsidiary. Not a subsidiary. Is it an associate? Generally voting power is between 20 to 50%. Actual is also 20%. So the remark is yes, it is an associate. It is an associate. So therefore, this standard IAS 27 becomes applicable. Is it a JV? Condition for JV is there must be joint control. Actual is not specified in the question. So remark is this is not a joint venture. But if it is one of the three, then the standard is applicable. And we have three choices. One is cost model, second is fair value model, and in IAS 27 there is a third model also allowed, equity method. But we will not follow equity method right now, not specified in the question. So if you follow only cost model, then just one accounting will be required. If you follow fair value approach, then every time there is a change in fair value, you have to record the change in fair value. So write a note. Since it is an associate, IAS 27 will apply. The company can either follow cost model or fair value model as per IFRS 9 or equity method as described in IAS 28. As described in IAS 28. Now write down case 1 cost model. Cost model, only one entry, right? 1/4/18. Investment account debit to bank account. Investment account debit to bank account 1,50,000. over. Now write down case 2, FVTPL. FVTPL. Journal entries 1418. 1418. Investment account to bank account 1,50,000. Investment account debit to bank account 1,50,000. And then every day, every reporting date, if there is a change in fair value, recognize in profit and loss account. So now write 31st March 19. Investment account debit to profit and loss account 60,000. 10,000 into 6. And immediately below that one more entry, 31st March 20. 31st March 20. P&L account debit to investment account 4 into 10,000. Loss 40,000. 40,000. Now write down case 3, FVT OCI. Case 3, FVT OCI. Same entries, only instead of P&L account, write OCI. So first entry 1418. Again write fast. Investment account debit to bank account 1,50,000. 1,50,000. Then 31st March 19. Investment account debit to investment reserve 60,000. 60,000. Investment reserve in bracket OCI. Right? And one more entry. 31st March 2020. Investment reserve OCI account debit 40,000 to investment account 40,000. Being investment revalued. Done. Equity method we have not yet discussed. So we will not take the third method, equity method. The details are also not available. Paragraph number 6. Dividend income from subsidiary, associate or joint venture. This standard says whenever the subsidiary, associate or joint venture declares the dividend, then the investor will recognize dividend income subject to the right to receive the dividend is established. When is right to receive the dividend established? Dividend is declared by AGM in case of final dividend, or dividend is declared by board of directors in case of interim dividend. So what is the treatment of dividend income? Dividend income will be recognized in profit and loss account. First rule, when the right to receive is established. Second, the dividend income will be shown in profit and loss account unless the entity elects to use the equity method, in which case the dividend is recognized as a reduction from the carrying amount of the investment. So accounting treatment will be 1. Your bank account debit to P&L account. If you are following cost or fair value model, final effect. And if you are following equity method, which we are going to discuss in detail in the IAS 28, then the dividend received will be reduced from the carrying amount of investment. That is called equity method. When the associate or joint venture has made the profit, we have recognized our share. So when they declare the dividend, we have to reduce the carrying amount. As the net asset increases or decreases, the carrying amount of investment also changes. So when they earn profit, we increase investment. When they declare dividend, we reduce the investment. Now solve this small question on dividend. ASF Limited purchased shares of B Limited for rupees 30 on 1/6/2020. ASF Limited received dividend from B Limited for the year ended 31st March 2020 at rupees 4 per share. Right? Fair value of the investment on 31st March 2020 is rupees 29. Year ending date of ASF Limited is 30th June 2020. Past journal entries in the books of ASF Limited. When was the share purchase? 1st June. Dividend is related to year ended 31st March 2020, but this dividend will be credited to profit and loss. And we are also going to revalue the investment. We purchase investment at 30 rupees. Now the price is 29, so 1 rupees loss. So write down first entry, 1st June 2020. 1st June 2020, 2020. Investment account debit to bank account. Investment account debit to bank account 30/30. One more entry on 30th June 2020. 30th June 2020. Bank account debit to P&L account 4/4. Being dividend received. One more entry, 30th June 2020. P&L account debit to investment account 1/1. Being investment revalued. Paragraph 7 now. Accounting treatment for investment in associate, subsidiary, joint venture which is classified as held for sale. Okay. There are two methods of accounting usually we follow. One is called cost model and one is called fair value model. So when the investment that are accounted at cost are subsequently classified as held for sale or for distribution or included in a disposal group, then accounting would be done as per IFRS 5. Okay. So in case if investment is carried at cost model, you apply IFRS 5. That is held for sale. IFRS 5 says the carrying amount of the investment will be carrying amount or fair value less cost to sell, whichever is lower. But in case if you are carrying investment at fair value, then you continue to apply the fair value accounting, even if it is held for sale, because as the fair value will go up or down, the investment value will also be accordingly adjusted. This standard deals with one more aspect called reorganization. But before reorganization, there is a paragraph I would like to discuss. This paragraph, number 8. When a parent ceases to be an investment entity, or when a parent company becomes an investment entity, that means investment entity to non-investment entity, or from non-investment entity to investment entity. So there are two possibilities which I have summarized in the form of a small table. So when an entity becomes an investment entity, investment entities are exempted from consolidation. Investment entities only account at FVTPL. FVTPL. So what they will do? They will account the investment from the date they become investment entity as per IFRS 9. Category would be FVTPL. Note number 1. So when you are going to categorize it as FVTPL, there may be some difference between the carrying amount and fair value. Okay. Suppose you are carrying it at cost and now you are measuring it at FVTPL. So difference will be transferred to profit and loss account. Suppose earlier you were measuring it at FVT OCI. Possible? Because other than investment entity, you have 3 choices. Cost, FVTPL, FVT, OCI. Investment entity has only one choice. FVTPL. So earlier if you are following FVT OCI, now there is an exception to the general rule. Mark important. Usually if there is a balance in FVT OCI equity instrument, if there is a balance in OCI account and if it is an FVT OCI equity instrument, normally it is not reclassified to P&L account. But now in the standard they have given an exemption. Any cumulative balance in OCI will be recycled to profit and loss account. Only when a non-investment entity becomes an investment entity. So this seems to be an exception to IFRS, as recycling is not allowed. Now look at this column. Earlier it was an investment entity, but now it is no longer an investment entity. So earlier what model they were following? FVTPL. Now they can follow either cost model. Okay. So fair value on the date of change of status will become the deemed cost. So don't do anything, but this will become the cost for future accounting. So you don't have to go back and find out what was the cost originally and then the difference. Ignore everything. Whatever is the fair value today on the date of change in status, that is the deemed cost. An option to continue to account for an investment in subsidiary in accordance with IFRS 9. So you can continue with the FVTPL model. You can continue with the FVT OCI also. So now we'll come to reorganization. Paragraph 9. This standard deals with a very unique situation when a new parent is created, okay, from the old parent. How? We'll see. This is a company called Google. They formed a new company called Alphabet, okay, and this Alphabet has become the parent of Google. They have acquired all the shares from shareholders of Google and they have issued their own shares. So who has become the parent of Google now? Alphabet. So how will you do the accounting? In the book separate financial statement of this company, at what price the investment in Google will be appearing? That is the issue. So when reorganization results in creation of a new parent, the new parent account for investment at cost if the following conditions are satisfied. So what are the 3 conditions? First condition is that the new parent obtains control over the original parent by issuing equity instrument in exchange for existing equity share. So in this example, Alphabet will issue equity share in exchange of equity share of Google. Second, the assets and liabilities of the new group and the original group is the same immediately before and after the reorganization. How will that be possible? Because now this is a parent company, it has acquired all the shares of Google. So whatever are the assets and liabilities of Google will become the assets and liabilities of this group. If I prepare a consolidated financial statement of Alphabet, I will have to incorporate the same assets and liabilities of Google. And the third condition is the owners of the original parent before and after the reorganization have the same absolute and relative interest in the net asset of the new group. So what will happen if this Alphabet issues shares to all of them exactly in the same ratio in which they are holding shares in Google? They will have the same continued interest in Alphabet also. So their stake in the company in absolute terms and relative terms are the same. If these three conditions are satisfied, the new parent will account for investment at cost. How do you compute the cost? So the cost will be based on the equity as per the separate financial statement of original parent before the reorganization. New parent will measure the investment in original parent at its share of equity items as per separate financial statement of the original parent before such reorganization. So here the term separate financial statement has been used. The cost of investment will be equal to share of new parent in the equity of the original parent as shown in separate financial statement of original parent. So now you have to take some efforts. Complete the question first. Google Limited, a parent company, reorganizes its group structure. It creates a new company, Alphabet Limited, which issues equity shares in exchange of Google Limited. This is a real life story of Google and Alphabet, right? You know that? Little bit. Carrying amount of components of equity of Google Limited, write down rupees in crore, equity share capital 100, reserves 800, fair value reserve 200. So total equity as per separate financial statement is 1100. At what amount Alphabet Limited should recognize investment in Google Limited? The answer is 1100, same amount. So write down Alphabet Limited will recognize investment in Google Limited at 1100. That is the carrying amount of equity items on the date of reorganization. Carrying amount of equity items on the date of reorganization. Carrying amount of equity items on the date of reorganization. Paragraph 10. Exemption from CFS. In IFRS 10, you will study that there are certain entities which are exempted from the preparation of CFS. So when such entities are exempted from preparation of CFS, then what will they prepare? SFS. And if they prepare SFS, which standard they will apply? This standard they will apply. So such entities which are exempted from preparation of CFS have no choice but to apply IAS 27, and if they apply IAS 27, they have to follow all the principles of this standard. Now the last part is disclosure requirement when exemption from CFS is availed. Paragraph 11 is applicable to those companies who have not applied consolidation as per IFRS 10, the exempted entities. So these entities who have taken exemption under IFRS 10 will disclose in their notes to account the fact that the financial statements are separate financial statement. So they have to specifically mention that this is a separate financial statement. Exemption from consolidation has been used, and name and principal place of business of the entity which produces consolidated financial statement for public use, because this is one of the condition for exemption. So if you are exempted, at least one of your parent must be preparing CFS for public use, so you have to disclose the name and principal place of business. Then address where such consolidated financial statements are obtainable. Address where such consolidated financial statements are obtainable. List of significant investment, and you have to make a list of such investment in subsidiary, joint venture, associate, with the name of those investees, principal place of business, and its proportion of ownership interest held. And the last is description of method used to account for this investment. So 3 methods are allowed in SFS. You can either follow cost, fair value, or equity method. Next, paragraph number 12 is the disclosure requirement when an investment entity is a parent. Investment entity is already exempted from CFS. So when investment entity that is a parent prepares SFS as its only financial statement, it shall disclose that fact. So disclosure is similar to para 11. The investment entity shall also present the disclosure relating to investment entities required by IFRS 12. So other disclosures also will be given, which is required by IFRS 12, which is called disclosure of interest in other entities. Now paragraph 13 is applicable to whom? General disclosure requirement for all entities who do not fall under 11 and 12. 11 is for companies who have taken exemption under IFRS 10. 12 is for investment entity. Other entities. An entity shall apply all applicable IFRS when providing disclosures in its separate financial statement. All disclosures required by other IFRS will become applicable. Then, when a parent or an investor with joint control of or significant influence over an investee prepares separate financial statement, the parent or investor shall identify the financial statement prepared in accordance with IFRS 10, IFRS 11 or IAS 28 to which they relate. So they have to specify that there is a consolidated financial statement under IFRS 10 also, or 11 or 28. 11 is used for joint arrangement. 28 is used for investment in associate and joint venture. So that link they have to mention there. And the parent or investor shall also disclose in its separate financial statement the fact that financial statements are separate financial statement. Reasons why separate financial statements are prepared if not required by the law. And then you have to make a list of significant investment in subsidiary, joint venture and associates with the name of those investee, principal place and the proportion of ownership interest. Same disclosure was there in para 11 also. And then description of method used to account those investment. So this completes this wonderful standard Now we'll see two differences between IAS 27 and Ind AS 27. Okay. Separate financial statement IAS 27 requires the reason for providing separate financial statement if not required by the law. Like we studied just now, some minutes back, paragraph 13. Reasons why separate financial statements are prepared if not required by the law. This was given in para 13. In India, since the Companies Act mandates preparation of separate financial statement, such requirement have been removed in Ind AS 27. All companies in India have to mandatorily apply separate financial statement. So paragraph number 13, that line is not applicable for Ind AS. Next line, IAS 27 outlines the allows the entities to use the equity method to account for investment in subsidiary, JV and associates in their separate financial statement. This we discussed yesterday and students were surprised also, but it is allowed. In IAS 27, this option is not given in Ind AS 27. I'll make a small correction on the screen. This option is not given in Ind AS 27. The reason Ind AS 27 is given that equity method is not a measurement basis like cost and fair value method, but it is a separate method of consolidation in itself and therefore would lead to inconsistent accounting conceptually. Note down homework today. Problem for self-practice. Question number 4, 5, 6. Okay, you'll be able to solve. This standard is over.